We are in truly unprecedented times with a rapidly evolving macroeconomic environment and so many different factors coming into play. Over this past week, it was one of those weeks that they say a year can happen in 7 days, and we truly saw that. From a decision surrounding the minimum wage to the national energy crisis and the RBA governor speaking about the potential trajectory of inflation, this past week had 3 major decisions or events that could feed into the future of the Australian economy. And in today's weekly wrap, we're going to be unpacking them all.
Sit back and enjoy.
So up first, the Reserve Bank Governor Philip Lowe had an interview on the ABC. This by itself was significant because he does not have many interviews, and so it raised a lot of attention and had a lot of eyeballs on it, 500,000 plus tuning in to see what the RBA governor had to say. As we know, the backdrop for this current situation, the RBA's raised rates twice, and on the basis of all factors, probably ahead of consensus on each time. Obviously, we had a 50 basis point raise last time. We're sitting at 0.85%, still behind the curve compared to many other nations around the world, such as the Bank of England, RBNZ, and the Fed. However, we are into this rate hike cycle now. There are a few interesting remarks that attracted a lot of attention. This first thing that we're going to cover wasn't so much a decision, but it was more the event that will surround upcoming decisions surrounding the interest rate narrative, which we know will feed into a range of different areas, such as, of course, demand, growth, the ability to navigate this potential soft landing, and still be able to have the economic recovery out of the pandemic without risking the economic slowdown. And so some of the key takeaways here from the RBA governor. Of course, we know that we're moving out of this emergency settings of monetary policy, but what was fascinating was they anticipate inflation to get to 7%. As we know, inflation is currently sitting at 5.1% for the headline, 3.7% for the preferred measure of trend mean inflation. And of course, the stated aim is to get it back to that 2 to 3% band sustainably, as the central banks around the world are guiding and aiming for. It is going to take time, and what was interesting to see was, of course, there's been a lot of questions about where is this neutral rate, where does it stand, and how are we going to get there? What's the trajectory towards that? We're now at 0.85% on the RBA's monetary policy. The cash rate they're anticipating potentially we may get to is of 2.5%. This is of the midpoint of the inflation target between that 2 to 3% band. And actually, with an interest rate of 2.5% adjusted for inflation, it ends up with an interest rate of 0. Of course, the underlying question of how fast we get there, and indeed if we do get there, do we hike through it, depending on the events that will come, is the big question there. And of course, we know that the RBA, like many other central banks around the world, have moved to be data dependent, and rather than proactively moving, they're waiting to be guided by the data that comes through. This next part was an interesting one. There's a lot of contention about the fact that it's been discussed that yes, we were anticipating rates wouldn't move to 2024. But when you actually read the wording surrounding this initial discussion, the wording basically stated that we did not anticipate we would see conditions that would mean we would have to require into 2024, before 2024, sorry. And this was basically reaffirmed by the governor, Philip Lowe. Of course, the recovery has been stronger than was initially anticipated. We've got a strong labour market, 3.9% unemployment now. And the question is, can we maintain this economic recovery while, of course, curtailing inflation into that more sustainable level? We're seeing here some discussion surrounding the unemployment, but the interesting part of this discussion is, of course, as we know, we've had high household savings over this past period with coordinated monetary and fiscal policy side of things. We know that household savings, around $250 billion has been put away, but we're into a period now where there's negative real wages. If inflation gets out to 7% plus, real wages will go further backwards. Of course, we'll talk about the minimum wage raise later on in this video, so stay tuned for that. But the question is, what happens to the household savings? We're going to start eating into it, of course, as mortgage repayments rise up as well. That's going to have a higher burden and a higher share of total income as well for individuals. And so consumption and what plays out on the demand side is going to be an area that everybody's watching for. We know that the supply side pressures are hopefully going to be fading into the back end of this year, which has been guided for by all of the central banks around the world, including the RBA. But the demand side is going to be fascinating, and how the interplay of course, the household savings numbers, but of course, with the rising interest rates, what that means for particularly discretionary spend as well. And then flowing through to the second major decision this past week, it had to do with energy. We are all aware that energy has been in the headlines over this past period. We know that there's been energy shortfalls, there's been issues with energy supply. We know that the crisis in Ukraine and the situation over in Europe is only exacerbating those problems, and the supply chain bottlenecks. But over this past week, the Australian Energy Market Operator, AEMO, has suspended the NEM, the National Electricity Market. This means that instead of the price for wholesale electricity being set competitively through the market mechanisms, the operator AEMO will set the fixed prices and will take a greater role in directing which power stations generate energy and when. It's quite a significant step. It's the first of its kind, and it really speaks to, as it states here, the depth of the price and supply crisis. Of course, they wouldn't want to be making that decision unless they had to, but before we dive into why that's been done and what happens from here, just to get that contextual understanding, national electricity market is a wholesale market where generators are paid for the electricity they produce. So at one side of the equation, we have the generators generating the electricity. Then obviously it's sold sold through wholesale. Then the retailers get it, and then obviously we're able to turn on our lights, or potentially at the offices or the factories, they're able to get that. But it goes through a process. It's easy for us as the end users, but there is a process to get it from the generators all the way through. And so to understand the national electricity market itself, it covers 5 regions. It's around about 80% of the total electricity in Australia. There's 2 regions, WA and NT, that have their own markets there. And you can see here the areas and the regions that are connected through that. What's fascinating is, as we mentioned, it's quite a process. This is a great ABC News article that gives that overview of it. But energy is generated, then obviously it's transmitted, then it's distributed, and then it ends up with the end users, which comes through that. What's fascinating, however, is, of course, the mix of electricity generation. This is 2020 to 2021, but we can see here in terms of renewables, we've got 4% makeup, 10% makeup, 7% makeup. So it's roughly only about 20% on the renewable front from wind, hydro, and solar, which will be the big 3. But coal is such a significant component, still over around about 2/3 of total annual generation. But what's worth noting as well is, if you've been keeping up with the headlines, around 20 to 30%, depending on the period of time, of coal generation supply is currently offline or undergoing maintenance or having supply issues. And so obviously that's leading to and exacerbating the issues that we're having on the energy front and the electricity front. And so what happened over this past week? So under the National Electricity Market's rules, price caps for generators can be imposed when costs in the wholesale power market breach the maximum thresholds. That's what's happened over the past period, initially in Queensland, then in New South Wales, because of course wholesale prices have been soaring in response to the supply crunch. As you know, it's supply and demand. What's interesting is we're getting pressures on both sides of the equation. So supply is obviously being throttled or inhibited with the range of issues that we're having on that front, but demand is also rising as well. I'm sure many of you are familiar with the freezing cold winter that we've had over this past period. There's been a massive uplift in terms of demand for energy generation, and so that's where the struggles are coming. However, as we know, there needs to be an incentive price to be generating or producing any commodity, but the imposition of a price cap prompted a bunch of so-called peaking power providers to pull back from the market over concerns, because if obviously there's a cap on the amount that they're able to be charging for that, then potentially they may be running at a loss, or it might not be considered profitable for them. And so as a result of that, AEMO shut down the national electricity market and instructed them to continue to run, but they'll then be provided with greater levels of compensation. Now, there's a lot of questions about what happens from here. Obviously, as we know, there's a lot of further discussions and events that will continue to evolve in the energy market. We know that renewables is the focus. We saw the green slide of the election, but of course, this transition out from coal is going to be important because of how significant of a component of the electricity mix that it currently is. We know that renewables aren't quite there yet. But what's fascinating about this near-term picture as well is there's going to be discussions about market functioning and how this will play out, particularly if these supply-side pressures continue to persist moving forward. And then the third big decision or event over the past week in the Australian macroeconomic climate had to do with the minimum wages. I'd love to know your thoughts on it all firstly too, so drop in a comment below. Let us know your thoughts on the big past week. If you're new here, welcome. We've just launched this second channel. Daily videos coming at you with plenty of information across the markets and the macroeconomic picture, so make sure you've subscribed and turn your bell notifications on. But the minimum wages rose over this past week. This was a promise that Anthony Albanese took to the election, and obviously Labor came to power there. Minimum wages will be increased by at least $40 a week, lifting from $20.33 to $21.38 for the hourly pay. It's a 5.2% increase to the national minimum wage and a 4.6% for the award minimums. Just for a bit of the contextual backdrop, that's over 2.5 million Australians that will be affected by that and will come into effect from the 1st of July. So the next financial year, obviously a couple of weeks away. But there were some exemptions that were pulled out of that, and that included aviation, tourism, and the hospitality sectors. Because of exceptional circumstances, particularly many of these sectors are just trying to find their own feet as we get this reopening really getting back to normal. And so just for that further understanding about how that will all look, I think what's interesting about this all is the contrasting views on it, because obviously it's a significant move, and there's always going to be people who are extremely passionate about it on either side of the equation. We can see Anthony Albanese, the new PM, absolutely welcomed today's decision. Australian Council of Trade Unions said it was a victory for wage workers, while the Australian Chamber of Commerce, however, warned the decision could put businesses under more stress. Of course, there is no right or wrong answer. There's just a range of different discussion points, and we'll have to see how the narrative plays out from here. But as we know, there has been rising inequality, which has really been amplified over this past period with the pandemic, lockdowns, people staying at home, people still able to work, and particularly with real wages going backwards because of inflation as well. Everyday citizens have been struggling with the cost of living. It was a big election discussion point as well. And we're seeing it coming through with the high levels of inflation, but particularly in those key areas, your gas prices, your groceries, and all of those other factors. And so, yes, there's inflationary pressures on citizens and something had to be done. But then the other trade-off is on what this means potentially for small businesses and the effects on them who are already struggling with things such as rising input costs, the labour shortages and the very tight labour market. And then the other question of, will this actually end up being further inflationary, which may further exacerbate the cost of living discussions? This phrase has often been used over the past couple of years. These truly are unprecedented times, and nobody knows how the situation is going to evolve. There's still a lot of data points that we're still awaiting. There's an upcoming earnings season for an insight into how companies are going and how much of the rising input costs they're able to pass on to their customers. Of course, we're still waiting for more inflation data. And on the supply side, waiting to see if these inflationary pressures will subside naturally, particularly towards the back end of the year. And then as the hiking cycle continues to pick up pace, what type of effect that will have on demand? And ultimately, can we navigate and stick this soft landing? Central banks are taking a wait-and-see approach while continuing to be active in their decisions to move the rates higher. There's plenty of unanswered questions, and it looks like we're heading into the next chapter of this cycle. It's going to be a fascinating one that we'll continue to watch. A big thank you for joining us, and for now, stay well and happy investing.